Hello, everyone, and welcome back to Synaptic Investing. I hope you're having a fantastic week and are ready for another deep dive. Today, we're breaking down a company that's truly foundational. It's the plumbing of the internet. Cisco Systems, Inc. On the surface, it's this established tech giant, maybe seen as a bit mature.
Yeah.
But the real question for us as long-term investors is this. In this age of AI and cybersecurity, is Cisco successfully reinventing itself, or are there hidden risks the market might be overlooking? That's what we're here to find out.
That's a massive question. And before we really get into the weeds on Cisco, just a quick note for everyone watching.
For those who want to act on these investing ideas, having a professional-grade platform is key. We use Interactive Brokers, and we've partnered with them to get our viewers a stock bonus when they sign up.
So they get a bonus and support the channel at the same time. That link is in the description, right? That's right. And of course, if you find value in this kind of in-depth discussion, the best way to let us know and to get the next one is to subscribe and like the video. It truly helps the channel. And if you have any questions regarding the company, please manifest yourself in the comment section.
Perfect. Now let's get into it. Pillar number 1, the business model. Let's unpack Cisco's core.
Okay, let's unpack this. We know Cisco is this titan in networking, but how exactly do they, make their money today? And how is that changing from just selling boxes?
Well, fundamentally, Cisco is still the essential plumbing, as you put it, for the internet and for basically every large corporate network out there.
Yeah.
Historically, they were absolutely synonymous with selling the physical hardware, the routers, the switches. That was the game. And look, that hardware, it still remains a really core component of their revenue. It's foundational. But there's been a very, very deliberate strategic pivot, especially under Chuck Robbins' leadership. They're consciously moving toward a much more resilient, more predictable model. And that means really emphasizing software and, crucially, recurring services.
Okay, so resilience and predictability. That sounds like music to an investor's ears. How does that break down in terms of their revenue streams?
Right. You can really break it down to 3 main buckets now. First, you've still got hardware sales. That's the core physical stuff. Network switches, routers, wireless gear, security appliances. And like I said, even with the shift, this is still the biggest chunk of their product revenue. It matters a lot.
Still the foundation, then. What's the second bucket?
The second is software licensing. And this is where you really see that strategic shift playing out. It's growing fast. And the key thing here is that most of it, the vast majority, is now subscription-based. Think network management tools, security software, collaboration platforms like Webex. These aren't just add-ons. They really complement the hardware, making the whole system stickier. And those subscriptions, that's the predictable, recurring revenue stream they're chasing.
Makes sense. And the third category?
That would be service contracts. And honestly, this is often overlooked, but it's hugely profitable and almost entirely recurring revenue. This is the critical technical support, the training, the consulting services that big companies rely on for their absolutely mission-critical networks. If you're a bank or a global logistics firm, you cannot afford downtime. These services are basically non-negotiable insurance. They pay for it year after year.
Okay, so you've laid out this vision, the shift towards software, towards services, but, lots of companies talk about transformation. What's the actual proof? How do we know this is really working for Cisco?
That's the right question to ask. And the evidence is actually quite compelling when you look at the numbers. If you check their fiscal year 2024 results, their total subscription revenue hit $27.4 billion.
$27.4 billion.
Yeah. And what's really significant is that now represents 51%. Clear majority of their total company revenue.
So over half their revenue is now subscription-based.
Exactly. And if you dig into the software piece specifically, software subscriptions now make up something like 89% of their total software revenue. So these aren't just like small changes at the edges. This shows a deep structural shift. They've really executed on moving away from just selling hardware towards that more predictable recurring model. It's clear in the financials. #TechTags 1.2, the intelligibility and longevity of Cisco's model.
Okay, so it's definitely not just about selling boxes anymore. That's crystal clear. But how durable is this new kind of hybrid model? When you look out, say, 10 or 20 years, is this business built to last, or are there potential weak spots?
I think the core intelligibility of what Cisco does gives it incredible durability. They provide essential digital infrastructure. That's the key. Yeah. Think about it. The world runs on data. The amount of data is just exploding, right? Streaming, cloud, IoT, everything. And all that data needs faster, more capable, and critically more secure pipes to travel through. That fundamental need isn't going away. It's only intensifying.
So the basic demand is structurally growing.
Absolutely. And it's tied into these massive long-term secular trends that are shaping, well, everything. First, you've got data proliferation and artificial intelligence. The sheer volume of data from IoT, cloud, and now generative AI, it's staggering. This creates this insatiable demand for better networking. And crucially, AI workloads. They're very sensitive to network performance. They need that high-speed, low-latency, super secure connectivity that's, frankly, Cisco's bread and butter. This isn't some cyclical blip. It's a fundamental re-architecting. We saw that stat, something like 97% of IT leaders see a modern network as absolutely critical for AI. That tells you something.
97%, that's almost universal.
It really is. Then second, there's the cybersecurity imperative. As everyone shifts to hybrid work, multi-cloud setups, the attack surface just gets bigger and bigger. So security that's built into the network, not just bolted on, is becoming non-negotiable. And you see forecasts for the network security market growing at, 14% plus, compounded annually through 2032. That's a huge tailwind for Cisco's integrated offerings.
Okay, AI and security. What's the third trend?
The third is the broader industry shift to software and services. We're seeing networking itself move towards software-defined approaches like SD-WAN and consumption models like Network as a Service or NOS. Now, you could argue this threatens legacy hardware, right? The idea of generic boxes running smart software. But Cisco's pivot shows they're adapting. They're leading in areas like SD-WAN. It's not that customers don't need networking. It's just how they buy and manage it is changing, and Cisco's adapting to that consumption shift.
Right. And this is where it gets really interesting for me. So they're not just selling the pipes anymore, they're selling the intelligence that makes those pipes smart. Moving up the value chain.
Precisely. That's the perfect way to put it. They're evolving way beyond just being the picks and shovels provider. It used to be about moving packets, point A to point B. Simple enough, conceptually. But look at the acquisitions, especially that massive $28 billion deal for Splunk, the data observability company. That signals a huge move up the value chain. They're not just selling connectivity now. They're selling the intelligence layer that understands, secures, and optimizes the data flowing through those pipes.
So it makes their stuff more critical to actual business outcomes.
Exactly. Things like security posture, application performance, ensuring uptime. These are core business needs. By tying networking to observability and security, Cisco makes itself much stickier, much more essential. It really strengthens the whole model for the long run.
Okay, every great long-term investment needs a moat, right? Some kind of durable competitive advantage. For Cisco, what is their fortress? Why is it so damn hard for competitors to really take them down, especially when networking feels like such a competitive space?
You're absolutely right. The moat is critical. And for Cisco, their most formidable economic moat really comes down to exceptionally high switching costs. And these costs aren't just monetary. They're deeply embedded in the technology and in the human capital involved.
Human capital. Explain that a bit more.
Well, think about an enterprise network. It's not just hardware. It's the central nervous system of the whole organization. It's incredibly complex. It's totally mission critical. And over years, maybe even decades, it gets customized and tweaked specifically for that company's needs, integrated with all their other systems. So once you've built your entire digital world around Cisco's architecture, ripping it all out to replace it with a competitor, the cost, the risk, the sheer disruption involved, it's just immense. It's daunting for most IT departments even to contemplate.
So the tech itself creates lock-in.
Definitely.
Yeah.
But it's powerfully reinforced by some significant intangible assets as well. First, there's the brand and reputation. For decades, Cisco has meant best-in-class performance, rock-solid reliability, strong security. In high-stakes environments like hospitals, financial trading floors where network failure is catastrophic, that old saying, nobody ever got fired for buying Cisco. It still holds a lot of weight in purchasing decisions. There's deep-seated trust there.
That reputation is hard-earned, I imagine.
Absolutely. And then there's this other really unique intangible, the Cisco certification ecosystem. Cisco has actively cultivated this huge global network of IT professionals, trained and certified specifically on their gear and software. CCNA, CCNP, the really high-end CCIE.
Those are industry standards almost.
Exactly. These aren't trivial certs. They represent deep expertise in Cisco's proprietary systems. So you have this massive global talent pool whose careers are literally built around knowing Cisco inside and out. They've invested their own time and money into this. So for a customer, Moving away from Cisco doesn't just mean buying new hardware. It means potentially retraining their entire IT team from scratch.
Ah, so the people are locked in too, not just the tech.
Precisely. It creates this powerful human capital lock-in alongside the technical lock-in. It makes switching incredibly painful and costly, far beyond just the price tag of the new equipment.
Okay, that makes the theory really clear. But can you give us a concrete example? Like, walk us through how this switching cost moat plays out in the real world for a specific customer.
Sure, let's paint a picture. Imagine a large hospital system, multiple buildings, clinics, ERs, the works. And let's say they've standardized on Cisco networking gear for, say, the last 10, maybe 15 years. Their whole IT department, from junior admins up to senior architects, they likely hold various Cisco certifications. They have deep institutional knowledge of Cisco iOS, the command line, the management tools. It's second nature to them.
They live and breathe Cisco.
Pretty much.
Yeah.
And all their network monitoring systems, their super strict security policies, maybe even custom automation scripts they've written, it's all built for that specific Cisco environment, tailored over many years.
Okay, set the scene. Now what happens?
Now, imagine a strong competitor, let's say Arista Networks, known for data center switching, comes knocking. They offer the hospital a really tempting deal on new switches for their data centers. A 15% price discount compared to Cisco's quote for the refresh.
15%. On a big hardware purchase, that sounds like real money.
It does, on the surface.
Yeah.
But now, let's think about what happens if the hospital actually tries to take that deal. They'd face, frankly, staggering costs and risks that dwarf that 15% hardware saving. First, the pure capital expense of just physically replacing all that gear across their complex network. We're talking potentially millions just for the hardware swap. Second, and this is critical for a hospital, the immense risk of downtime during the migration. You cannot have the network go down in a 247 healthcare setting. It's unthinkable. Patient safety is paramount.
Absolutely critical.
Third, they'd have to launch a massive, likely multi-year, multi-million-dollar project just to retrain their entire IT staff, potentially hundreds of people on Arista's platform, operating system, everything. All that Cisco knowledge becomes less relevant. And fourth, they'd need to painstakingly rewrite and validate maybe thousands of lines of security policies, automation code, all built for Cisco. That's not just time-consuming. It introduces huge risks of errors, new vulnerabilities, potentially compromising patient data security.
Wow, when you list it like that.
Right. Suddenly, that 15% hardware discount looks tiny compared to the total cost of ownership, the operational chaos, and the sheer risk involved in switching. So what happens? Almost certainly, the hospital sticks with Cisco for their next refresh, even if the hardware seems a bit pricier up front. The switching costs are just too high. That's the moat in action, powerful operational inertia.
So the moat is incredibly strong today. That example really drives it home. But what about tomorrow? With everything changing so fast, cloud, AI, software-defined everything, is that moat holding steady? Is it maybe shrinking, or could it even be getting stronger?
That's the crucial question about the future trajectory. I'd say the moat appears quite stable, and actually Cisco's strategic moves could potentially widen it further over the next decade or so. There's pretty clear evidence of stability right now. Cisco still holds dominant market share in its core areas.
Right.
You mentioned the 2023 numbers, like 43.7% in Ethernet switches, 35.7% in routers.
Still the big player.
Definitely. Now, they absolutely face tough competition from companies like Huawei, Arista, HPE, Juniper. It's not a monopoly. But those numbers show persistent leadership. And customer loyalty metrics are strong, too. That 81% figure for loyal users is significant. Plus, partners see higher retention when they bundle Cisco services. That tells you customers are sticky.
Okay, so stable for now. But what about those forces trying to narrow the moat, the threats?
Yeah, we have to acknowledge the forces narrowing the moat. The biggest long-term threat is clearly that architectural shift toward cloud computing and software-defined networking, SDN. The idea is that SDN could allow more generic white box hardware to be used, with the intelligence coming from software, potentially from different vendors or cloud providers. That could, in theory, reduce the reliance on Cisco's tightly integrated hardware-software stack and make swapping components easier over time. That's the bear case, essentially.
Makes sense. So how is Cisco fighting back?
Well, this is where their strategic pivot becomes so important. It's a direct countermeasure. By deeply integrating things like security and observability, especially with Splunk, into the network fabric itself, they're basically expanding the definition of lock-in. The moat isn't just about the router's command line anymore. It's becoming about the entire security and data analytics platform that's woven into the network.
Ah, so switching isn't just swapping a box, it's swapping your whole security and monitoring system too.
Exactly. As customers adopt these more integrated solutions, the cost, complexity, and risk of ripping out Cisco potentially skyrockets, it arguably widens the moat for this next era of computing. It makes them even more indispensable if they execute well. And what's fascinating here, their certification program actually plays a really unique role in reinforcing all this. Because IT professionals invest their own time and money to get Cisco certified for their own career benefits. They become internal advocates within their organizations. This creates this powerful kind of bottom-up pressure to stick with Cisco, effectively outsourcing some of the moat reinforcement to the very people who would have to execute a switch. It's quite clever, really.
Okay, even with a powerful moat like that, a company still needs great leadership, especially to navigate these huge industry shifts we've been talking about. How has Chuck Robbins, the CEO, actually steered Cisco? What's his core philosophy driving their strategy?
Chuck Robbins is a really pivotal figure. CEO since 2015, but he's a longtime Cisco veteran, over 25 years there. Came up through sales and partnerships, so he knows the customers and the channel inside out. And his tenure, it's been very clearly defined by one consistent theme: transforming Cisco, moving it from its, traditional hardware-centric past towards being much more about software services, subscriptions, getting it ready for what he calls a digital-first world.
So transformation is the core theme. What are the key principles behind that?
You can see a few key tenets in his approach. First, absolutely, strategic transformation. He's not just managing the status quo, he's actively driving change, steering the ship towards software, recurring revenue, cloud, AI, cybersecurity. You see it in their strategy documents, but more importantly, you see it in where they're putting their money, their capital allocation decisions. That's where the real priorities show up.
Right. Actions speak louder than words. What else?
Second, he seems to take a pretty broad stakeholder-oriented view. He's active outside, Cisco chair of the Business Roundtable, for instance. And he publicly talks about things like CSR, diversity, data privacy, not just as nice-to-haves, but as fundamental to building long-term value. That wider perspective often correlates with sustainable success.
Interesting. And the third point?
Third is a definite focus on culture. You see all those Best Place to Work awards Cisco consistently gets. That's not accidental. It seems to be a direct result of his initiatives to improve the employee experience. It shows he understands that your people, your human capital, are a critical asset, especially in tech. A strong culture can be a real competitive advantage.
So transformation, stakeholder view, culture, it sounds like a long-term owner-minded approach.
I think that's fair. He's clearly trying to reposition the business model for more predictable growth while consistently returning capital to shareholders. And look at that Splunk deal again, $28 billion. That was audacious, transformative. That's the kind of big calculated bet a leader makes when they're focused on securing the company's long-term competitive position in a landscape that's changing incredibly fast. Hashtag 3.2, Cisco's capital allocation track record.
You mentioned capital allocation being the real test of a CEO's philosophy. So let's drill into that. How does Cisco actually put its cash, and it generates a lot of cash to work? Where does it go?
Yeah, tracking the cash is critical for investors. And Cisco's management has been remarkably consistent and, I'd argue, quite disciplined in how they deploy it across three main pillars. First is reinvestment in the core business, mainly through R&D. They spend a lot on internal innovation. R&D spending has climbed steadily from around $6.3 billion back in fiscal 2020 to nearly $8.0 billion in fiscal 2024. As a percentage of revenue, that's consistently in the 13-15% range annually. That's a serious commitment to staying technologically relevant and developing new products organically.
Okay, significant internal investment. What's pillar number 2?
Pillar 2 is strategic acquisitions, M&A. Cisco's always used M&A. They've bought over 200 companies throughout their history. But in the last 5 years or so, the focus has been really sharp, accelerating that pivot into software security and observability. And the absolute centerpiece, the defining move here, was obviously the $28 billion acquisition of Splunk in 2023.
Right, the big one.
The whole idea there is to combine Cisco's network visibility with Splunk's data analytics power to create this unified platform for security and observability, especially for the AI era. And importantly, they structured the deal with financial discipline in mind. It's expected to be cash flow positive and add to their adjusted margins and earnings per share within just 2 fiscal years after closing.
So a big bet, but with a relatively quick path to financial contribution.
Exactly. It suggests a strong strategic rationale, not just growth for growth's sake. And the third pillar is shareholder returns. Cisco has a very strong track record here. They started paying a dividend back in 2011 and have increased it for 13 straight years now. It's grown quite a bit, up to $1.64 annualized for fiscal 2025.
Consistent dividend growth, investors like that? Buybacks, too?
Oh, yeah. They've been aggressive repurchasers.
Yeah.
Between fiscal 17 and 21, they bought back something like $47.5 billion worth of shares. And more recently, in Q2 of fiscal 25, the board authorized another $15 billion for buybacks, leaving around $17 billion still authorized. That shows confidence in future cash flow.
So R&D, M&A, and returns to shareholders, how do you rate that overall approach? Is it rational?
If you apply a rationality test, I think it scores very highly. It seems highly rational and very shareholder-friendly. They're not just sitting on cash. They're balancing internal investment for organic growth, strategic external growth via M&A, and consistently returning the excess cash to owners. Even the huge Splunk deal, it looks like a logical strategic response to where the industry is heading, not just, empire building. It feels like a calculated move to secure their future dominance.
Okay, beyond the strategy and the capital allocation, just how strong is Cisco's financial position overall? Is it really a fortress balance sheet, or are there any hidden cracks or vulnerabilities we should be aware of?
Fortress is actually a pretty good word for it. You could genuinely characterize Cisco as a paragon of profitability and consistency. For decades, it's been this incredibly reliable earnings machine. Look at their GAAP net income over the last 5 full fiscal years, 20 through 24. It's consistently been in that $10 billion to $12.6 billion range annually. Now, FY24 was slightly lower at $10.3 billion.
A bit of a dip.
Yeah, but that mostly reflects a broader cyclical slowdown in the networking industry and probably some initial costs tied to integrating Splunk. The underlying profit engine is still incredibly robust, and this is supported by really strong margins. Their fiscal 2024 GAAP gross margin hit 64.7%. That's actually a 20-year high for them.
64.7% gross margin. That's impressive.
It really is. It shows exceptional operational control even when revenue growth is maybe a bit softer.
What about some of those key quality ratios investors look at?
Right, digging a bit deeper confirms the high quality. Let's take return on invested capital, ROIC. This measures how well they generate profit from all the capital tied up in the business. Cisco consistently generates ROIC well above its cost of capital. Historically, figures were often hovering in the low to mid-20s% range, which is excellent. Now, it has moderated recently, maybe into the mid-teens, largely because of that huge Splunk investment hitting the denominator. But even mid-teens ROIC still signals a superior wide moat business. Way above average.
Still earning good returns on its capital then. What about cash flow?
Free cash flow, FCF conversion. This is where Cisco really shines. It's just a prodigious cash generator. In fiscal 2023, for example, they generated almost $20 billion in cash from operations, 19.9B, compared to $12.06 in net income. That's a conversion rate of 158%.
Turning way more than their accounting profit into actual cash.
Exactly. Even in the slower fiscal 2024, they still converted over 100% of net income into operating cash flow.
Yeah.
It just demonstrates incredibly high-quality earnings and really efficient working capital management. They consistently turn profits into spendable cash.
And the balance sheet itself, debt levels.
That's the final piece of the fortress. Balance sheet strength. It provides a huge margin of safety. As of early 2024, their net debt to EBITDA ratio was super conservative, around 0.75x. Basically, less than 1 year's earnings covers their net debt. Their debt is incredibly well covered by cash flow. Interest payments covered more than 20 times over by EBIT. This kind of financial strength just gives management immense flexibility. They can keep investing, make big acquisitions like Splunk, return capital, weather downturns. They have a massive cushion. It's rock solid.
Okay, numbers and strategies tell one story, but what about the people actually using Cisco's products day in, day out? What's the word on the street from their customers? Is it all love or is it more complicated?
It's definitely nuanced, I'd say. The general sentiment seems positive, but it's not unconditional love, perhaps. Products are seen as powerful, reliable, but also complex. Let's look at the quantitative view first. Their Net Promoter Score, or NPS, is around plus 36. That's pretty healthy for enterprise B2B. You've got 59% promoters versus 23% detractors. And that 81% loyalty figure is quite high, suggesting customers stick around. If you look at specific products like their WebEx Contact Center, it gets great reviews like 4.7 out of 5 on Gartner Peer Insights, 96% willing to recommend. Strong numbers.
So the scores look pretty good. What about the qualitative feedback? What are people actually saying?
The qualitative view definitely reflects that nuance. You consistently hear praise for reliability, scalability, security. Those are the mission-critical things enterprises need, and Cisco delivers.
Yeah.
But you also hear common complaints. Product complexity is a big one. Occasional software bugs. and sometimes inconsistent customer support experiences. Like, I saw examples where users mentioned known issues, say, with basic call transfers in the contact center product that apparently persisted for months without effects. That kind of thing causes frustration.
Right, reliability is great, but if support is slow on bugs.
Exactly. It's also worth noting, though, that formal complaints, like to the Better Business Bureau, are actually very low, only about 38 in the last 3 years. And those tend to be about service or subscription issues, not core product failures.
So how do you synthesize all that? Loved, tolerated.
I think the synthesis is that customers often tolerate the complexity because the fundamental capability is indispensable. They need what Cisco provides for their core operations. So, deeply embedded enterprise customers. They're loyal, they value the power, the stability. The products are probably loved for what they enable when working well, but tolerated due to that complexity and occasional support friction. It's a relationship built on necessity and capability first, maybe delight second.
What about looking inside the company? Is Cisco seen as a vibrant, innovative place to work that attracts top talent? Or is it maybe getting bogged down by its sheer size and legacy ways?
That's a really insightful angle because culture and employee sentiment tell you a lot about a company's ability to adapt, right?
Yeah.
And honestly, at Cisco, the employee sentiment seems overwhelmingly positive, at least based on external measures. They consistently rank as a top global employer. Quantitatively, the numbers are pretty staggering. According to the Great Place to Work Institute, something like 96% of employees call Cisco a great place to work. Compare that to the U.S. average, which is 57%. That's a huge gap.
96%. That's incredible.
It really is. And they're always hitting the #1 spots on Fortune's best workplaces list. For tech, for parents, for millennials. The external accolades are remarkable for such a large, established company.
Okay, so the awards look fantastic, but what about the day-to-day reality? What do employees actually say in reviews?
Well, the qualitative view shows that tension you sometimes see. There are consistent highlights, excellent work-life balance, a flexible, supportive culture, great benefits. These clearly drive those high scores. But you also hear common criticisms, things like slow decision-making, excessive bureaucracy, big company stuff, and disruption from fairly frequent reorganizations or layoffs, which they apparently call LRs internally for limited restructuring.
Ah, the dreaded reorgs.
Yeah, and some reviews mention that career progression, especially salary growth, can be slow if you're a long-tenured individual contributor. Advancement might depend more on internal networking than just pure merit sometimes, which can be frustrating for people.
So how do you square those two views? Great place to work, but slow and bureaucratic.
That's the synthesis, and it reveals this really interesting tension. The fantastic external awards seem driven by the stability, the benefits, the generally good culture hallmarks of a successful incumbent, right?
Yeah.
But the internal complaints, bureaucracy, slow decisions, the LRs, those are classic big company problems. And this creates a fundamental strategic question for Cisco. Can a culture that is comfortable, stable, maybe even a bit slow, truly attract and retain the super agile, fast-moving, innovative talent they need to win in hyper-competitive areas like AI and advanced cybersecurity? It's a real balancing act between protecting the core and innovating fast enough for the future.
Okay, we've dissected the business model, the formidable moat, the leadership under Robbins, those fortress-like financials, even the customer and employee vibe. Now we get to the bottom line for you, the potential long-term investor. Is the price right? Is Cisco a buy at current levels?
Always the crucial question, isn't it? Price versus value. So let's look at the valuation as of, say, early August 2025. Cisco's trailing 12-month price to earnings, PE ratio, is sitting around 27.2 times. And its price to free cash flow, PFCF ratio, again trailing, is about 21.3 times.
Okay, 27 times earnings, 21 times free cash flow. How does that stack up historically for Cisco?
Well, that's the key point. If you compare these multiples to Cisco's historical averages, they represent a significant premium, that PE of roughly 27x. It's way above its own 5-year historical average, which has been closer to 19.3 times. And similarly, the PFCF around 21x is also quite elevated compared to where it usually trades, often in the low to mid-teens historically.
So the market's definitely paying up for Cisco right now compared to its past.
Exactly. Which leads to my crucial judgment here. Based on the business quality, the moat, the financial strength, all of which are excellent, the current stock price seems like a demanding entry point for a long-term, value-focused investor. The market isn't pricing Cisco like a sleepy legacy hardware company anymore. It's clearly pricing in a lot of optimism about this transformation into an AI and software powerhouse. That outcome, while strategically sound, isn't fully baked into the actual financial results yet. The quality is there, no doubt, but the current price doesn't seem to offer much of a margin of safety for someone looking for value. So you'd want a better price. What would look more attractive? Personally, I'd feel more comfortable seeing it trade closer to its historical average PE, maybe in that 18 to 20 times range. That would likely require a meaningful pullback from where it is today. Tag 5.2 primary growth engine and permanent risks.
You're saying the price is demanding, implying the market expects strong growth to justify it. So where is that future growth realistically going to come from? What's the main engine? And conversely, what are the biggest permanent risks that could derail Cisco, even with that strong moat?
The single most important growth engine for Cisco over the next decade, without a doubt, is the convergence of AI, networking, and security. That's the big play. They are strategically positioning themselves to be the absolutely indispensable platform for any enterprise deploying serious AI workloads. And this isn't just about selling faster routers, it's about using Splunk to provide that unified AI-powered security and full-stack observability. They want to be the central nervous system for the AI-driven enterprise.
The brain and nervous system, I like that analogy. Are we seeing any proof this engine is actually starting up?
Yeah, there's some encouraging early evidence. They apparently booked over $1 billion in AI-related infrastructure orders just this fiscal year, actually hitting their goal faster than expected. As companies scramble to build out AI capabilities, the need for smarter, more secure, highly automated networks is just going to explode. Cisco, with this integrated portfolio, is arguably uniquely positioned to deliver that whole package. We also saw strong growth recently in security, up something like 54% year over year in Q3 FY25, and observability up 24%. Those are clear signs the strategic pivot is gaining real traction.
Okay, so the growth story centers on AI, security, observability via Splunk. What about the flip side, the permanent risks? What could really hurt them long term?
Despite the strengths, there are genuine long-term risks that could permanently impair the business. First, and probably the most significant, is disruption from cloud-native competitors. The fear is that Cisco's integrated, often on-premise focused heritage gets outflanked by nimbler, software-first companies born in the cloud. Think Arista in networking, maybe Zscaler or CrowdStrike in security. If the market fundamentally shifts to preferring bust-of-breed cloud-native point solutions instead of Cisco's all-in-one approach, they could face permanent market share loss and pricing pressure.
The classic innovator's dilemma, almost.
Kind of. Second, there's the huge execution risk around failure to integrate Splunk. That $28 billion deal, it has to work. If they fail to integrate the technology smoothly, merge the cultures effectively, realize the promised synergies, or crucially, retain Splunk's loyal customer base, that would be a massive permanent destruction of value. It would hurt their balance sheet, their strategic position, everything. The stakes are incredibly high there.
A company-defining bet, indeed. Any other major risks?
The third one is the persistent threat of commoditization of core hardware. Yes, they're pivoting to software, but a big chunk of their revenue and profit still comes from high-margin switches and routers. If the performance gap between their proprietary gear and much cheaper white box alternatives keeps shrinking, those juicy hardware gross margins could face irreversible long-term pressure. That would hit the bottom line hard, even if the software business is growing.
Okay, so most people see Cisco as this solid, maybe slightly slow big tech company that's now making a serious, necessary push into AI and software with Splunk. That feels like the first level take. But what's the deeper second level insight here? What might the market be missing or perhaps underestimating?
That's a great way to frame it, looking beyond the obvious. The market consensus has definitely shifted, like we discussed. No longer legacy tech in decline. Now it's seen as this reborn giant successfully pivoting to AI. The stock price reflects that optimism. Analysts are generally saying things like moderate buy, but their price targets often suggest it's already fairly valued, with limited upside from here. So, consensus is good strategy, fairly priced.
Okay, that's the market view. What's the potential contrarian angle, the deeper analysis?
My contrarian view, or perhaps just a deeper dive, largely agrees with the market on the quality of the business and the basic logic of the strategy. Splunk is a strong fit. However, the potential second-level insight lies in the magnitude and the long-term durability of the competitive advantages this new integrated platform could forge. The market sees Splunk as adding a great software asset. Corrected, but maybe too simple. What I think is happening, or what Cisco is trying to make happen, is far more profound. They're attempting to build a single, unified operating system for an enterprise's entire digital infrastructure.
The operating system for the enterprise. Explain that.
Think about it. If your core network is Cisco, your security operations center runs on Cisco security, and your whole IT monitoring and observability platform is now Splunk, deeply integrated. How easy is it then to switch any major piece? The complexity and risks become almost insurmountable. The decision stops being, should we swap these switches for cheaper ones? It becomes, are we prepared to re-architect our entire IT and security stack, retrain 3 different departments, NetOps, SysOps, ITOps, and migrate petabytes of critical Splunk data?
That sounds terrifyingly difficult for a large organization.
Exactly. The vendor lock-in becomes exponentially stronger than just hardware lock-in. It's platform lock-in at a much deeper level. So the market might be correctly identifying the pieces, but potentially underestimating the synergistic power of combining them so tightly. This deep integration could create a moat that's vastly wider and more durable than just the sum of its parts. It could genuinely lay the foundation for another, say, 2 decades of infrastructure dominance for Cisco. And that possibility, that potential for multi-decade platform dominance might not be fully captured even in today's elevated valuation. That's the deeper second-level thought. #tag outro.
Wow. What an incredibly insightful deep dive into Cisco systems. It really paints a picture of a company undergoing a profound transformation, moving from hardware to this deeply integrated AI and software platform, all while keeping its financial house in amazing order and actively trying to widen that already powerful moat. It's much more dynamic than the old view might suggest.
Absolutely. And if you connect it to the bigger picture, Cisco's story really isn't just about one legacy tech company trying to stay relevant. It feels more like a crucial test case. A test of whether this kind of deep integration can truly build an almost impenetrable digital operating system for the modern enterprise, maybe setting the standard for years to come.
So what does this all mean for you, our listener, thinking about this company? Given everything we've unpacked today, the ambitious AI and Splunk strategy, the financial muscle, the cultural challenges, that potential for an enterprise OS, what are the 1 or 2 key indicators that you would watch most closely? What would you look for in Cisco's next few earnings reports or strategy updates to really confirm if that Splunk integration is delivering on its massive promise, or if maybe that big company inertia we talked about might be slowing things down more than hoped? We've covered a tremendous amount today. I really hope this deep dive has given you valuable insights into a company that, whether we realize it or not, is fundamental to how our digital world operates. Keep asking those critical questions, keep digging deeper, and we'll see you next time on The Deep Dive.